Hey traders! In this video, we're diving into some of the most powerful ICT concepts that have been game changers for consistent, successful trading. Today, we'll break down the definitions, core principles, and how to apply these strategies on live charts to help you catch high probability trades. If that sounds like something you're excited about, make sure to hit that like button. And if you're new here, don't forget to subscribe to stay updated with all our latest strategies. Let's start with the first concept, liquidity. As a trader, if you don't understand liquidity in the market, you might become the liquidity. Market makers use algorithms to hunt liquidity, and they know exactly how retail traders behave in the market. When you buy at a support level, you usually place your stop loss just below that level to protect your position. Market makers are fully aware of this, and their systems are designed to hunt these stop losses to generate liquidity in the market. Similarly, when you sell at a resistance level, the market might break through that resistance, hit your stop loss, and then move in the direction you originally anticipated. Why does this happen? Because the market is driven by liquidity. Liquidity is the primary cause of price movement. There are two main types of liquidity: buy-side liquidity and sell-side liquidity. Buy-side liquidity. According to Inner Circle Trader, buy-side liquidity refers to the volume of pending buy orders, also known as buy stops. When traders place sell orders, they often use buy stops as protection in case the market moves against their trade. These buy stops are typically positioned above price levels, like previous highs, weekly highs, or daily highs. These levels are considered buy-side liquidity, and market makers target these highs to convert pending orders into market orders, allowing them to push the market in the opposite direction. As shown in the example, equal highs are considered buy-side liquidity. Market makers sweep these old highs, clear the buy-side liquidity, and then drive the market down, which is a perfect example of a buy-side liquidity hunt. Now, sell-side liquidity, as defined by ICA, refers to the accumulation of pending sell orders, especially sell stop orders. When traders place buy orders, they use sell stops as protection in case the price drops. Sell stops are placed below key price levels like historical lows, including weekly and daily lows. These areas are considered sell-side liquidity, as they hold concentrated sell orders. Market makers aim to exploit this by pushing the market to these lows, triggering the sell stops, and converting them into market orders. Once this liquidity is grabbed, market makers often reverse the price direction to profit from retail traders. As you can see in this chart example, the market was in an uptrend, with buyers in control. When the market approached this resistance level, many traders expected a reversal. They entered short positions and placed their stop losses just above the resistance. At the same time, breakout traders anticipated a continuation of the upward movement, placing their buy entries above the resistance and stop losses below the level. However, the market makers exploited both groups. The price broke above resistance, triggering the stop losses of the short traders, then reversed, taking out the stop losses of the breakout traders positioned below the level. This manipulation, where the market sweeps liquidity from both sides before moving in the opposite direction, is known as a buy-side liquidity hunt. As seen in this chart example, the market was trending downward, with sellers in control. As the price reached a key support level, many traders anticipated a bounce and entered long positions, placing their stop losses just below the support. At the same time, some breakout traders were expecting the market to break through the support and continue lower, placing their sell entries below the level with their stop losses positioned above it. The market makers saw this liquidity on both sides. The price initially broke below the support, triggering the stop losses of the long traders and activating the sell orders from the breakout traders. But instead of continuing lower, the market reversed direction, moving back up and hitting the stop losses of the breakout traders. This is an example of a sell-side liquidity hunt, where the market sweeps liquidity below a support level before reversing sharply to the upside. Next on the list, displacement, a key ICT concept. Displacement refers to moving something from one place to another. In ICT trading, displacement represents a fast and energetic price move caused by large institutional orders. These moves indicate that smart money is actively participating in the market. Displacement helps traders identify the direction of these large orders. A bullish displacement move is a strong upward price movement, showing that smart money is buying into the market. To recognize a bullish displacement move, look for at least 3 bullish candlesticks in a row. These candlesticks should have large bodies and very small wicks, or no wicks at all. The price movement should be smooth, with no major retracements. A fair value gap, or FVG, between the candlesticks confirms displacement. The gap indicates that the market has moved quickly, leaving an area of inefficiency caused by smart money. This type of move shows that institutions are pushing the market higher with force. A bearish displacement move is a strong downward price movement, indicating that smart money is selling heavily. To recognize a bearish displacement move, look for at least 3 bearish candlesticks in a row. These candlesticks should have large bodies and little to no wicks. The price should drop with strong momentum and limited retracements. A fair value gap, or FVG, between the candlesticks confirms the displacement. This gap shows that the market has dropped quickly due to large institutional selling. This type of move shows that institutions are driving the market down. Now let's dive into some real chart examples to help you understand how to identify bullish and bearish displacement in action. First, we'll look at a bullish displacement example, which occurs after a sell-side liquidity sweep. In this chart, the market was trending downward and approached a significant support level. Many traders expected the market to break through this support and continue lower. As a result, they placed short orders, while traders going long positioned their stop losses just below the support. What happened next? The market briefly broke below the support level, triggering the stop losses of long traders and activating the sell orders of breakout traders expecting a continuation downward. This move swept the sell-side liquidity that was resting below the support level. However, instead of continuing lower, the market quickly reversed to the upside. This sharp reversal is what we call a bullish displacement. To identify it, look for at least 3 consecutive bullish candlesticks with strong bodies, which signal strong buying momentum. While minimal wicks are recommended, they're not essential for displacement. What matters most is the aggressive price move with minimal retracement. In addition, you may notice a fair value gap forming between the bullish candles. This gap represents a price imbalance created by smart money entering the market. The fair value gap serves as a confirmation that institutional players were involved in the displacement. This bullish displacement shows how smart money used the sell-side liquidity sweep to drive the market higher, trapping retail traders who were positioned short and benefiting from the liquidity grab. Now, let's look at a bearish displacement example, which happens after a buy-side liquidity sweep. In this case, the market was trending upward and reached a key resistance level. Many traders expected the market to break through the resistance and continue higher, while others entered short positions, placing their stop losses above the resistance level. The market briefly broke above the resistance, triggering the stop losses of short traders and activating the buy orders of those who anticipated a breakout. This move swept the buy-side liquidity, resting above the resistance level. However, instead of continuing upward, the market quickly reversed, closing back below the resistance level and moving downward aggressively. This reversal marks a bearish displacement. To spot this bearish displacement, look for at least 3 consecutive bearish candlesticks with strong bodies, showing clear momentum to the downside. Again, minimal wicks are recommended but not a requirement. The key is the strong, unbroken move down with little retracement. As with the bullish example, a fair value gap may form between the bearish candles, further confirming the displacement and highlighting the presence of smart money. This bearish displacement illustrates how the market makers swept buy-side liquidity above the resistance, trapping retail traders who were long, before driving the price lower in the opposite direction. Why is displacement important? Displacement is crucial because it reveals when smart money is actively entering the market with large orders. These strong price moves signal the direction of institutional flow. Understanding displacement is key, as we'll combine it with other ICT concepts such as order blocks, breaker blocks, and fair value gaps to identify high probability trade setups. And don't worry, we'll cover all of these concepts in detail and show you exactly how to use them together to pinpoint those high probability setups. By the end of this video, you'll have a clear understanding of how to leverage these powerful tools like a professional. Up next, fair value gap, another crucial ICT concept. An ICT fair value gap, also referred to as an imbalance or inefficiency, is a crucial concept in smart money trading. It can be applied across various markets including forex, stocks, crypto, and commodities. The ICT fair value gap is identified in a three-candle formation. The middle candle is generally larger, with a wider body, representing significant price momentum. The first and third candles are shorter and don't overlap the body of the middle candle. This creates a clear gap between the wick of the first candle and the wick of the third candle, referred to as the fair value gap. This gap highlights where the market moved too fast for balanced price action to occur, signaling institutional involvement. The gap between these wicks, where price hasn't been fully traded, is the area of inefficiency or imbalance. To trade effectively using the fair value gap, we must first determine the market's trend, as bullish and bearish fair value gaps behave differently. A bullish fair value gap forms in a bullish market. The middle candle is a strong bullish candle with a large body, and a gap exists between the high of the first candle and the low of the third candle. In a bullish trend, the fair value gap often acts as support, with price tending to fill this gap before continuing its upward movement. A bearish fair value gap occurs in a bearish market. In this case, the middle candle is a large bearish candle with a wide body, and a gap forms between the low of the first candle and the high of the third candle. In a bearish trend, the fair value gap typically acts as resistance, with price often retracing to fill the gap before continuing downward. Steps to trade using ICT fair value gaps. The first step is identifying the overall market trend, bullish or bearish. In a bullish trend, the market makes higher highs and higher lows, while in a bearish trend, the market forms lower highs and lower lows. Once the trend is identified, the next task is to locate a large candle with a wide body and small wicks. In a bullish trend, look for a strong bullish candle, and in a bearish trend, search for a large bearish candle. After identifying a large candle, examine the preceding and following candles. For a valid fair value gap, the bodies of these two candles should not overlap the body of the middle candle, creating a gap between the wicks of the first and third candles. In a bullish trend, the gap between the high of the first candle and the low of the third candle is your fair value gap. In a bearish trend, the fair value gap is marked between the low of the first candle and the high of the third candle. To increase the probability of success, ensure that the identified fair value gap aligns with significant levels, such as a previous resistance turned support in a bullish trend or support turned resistance in a bearish trend. If the market is trending bullish, wait for the price to retrace and test the fair value gap. When the price retraces and touches this gap, look for additional confirmation, such as a market structure shift or rejection on a lower time frame, before entering a buy trade. On higher time frames, such as the daily, you can execute trades on the same time frame. As you can see here, after the formation of a pin bar that was rejected from the fair value gap, the market moved up again. In a bearish trend, wait for the price to retrace upward and test the fair value gap. Once the gap is tested, look for technical confirmation like a rejection or structure shift to initiate a sell trade. Now, let's move to the next important concept. Order blocks. Order blocks are key zones in the market where large buy or sell orders have been placed by institutions, also known as smart money. These levels represent significant supply and demand areas that have already been rejected by the market, making them highly relevant for future price action. When price returns to an order block, there's a strong chance the market will react similarly, offering potential trading opportunities. However, while every supply or demand zone shows where price has reacted, not all supply and demand areas qualify as order blocks. Understanding the difference is essential for improving your trading strategy and avoiding common pitfalls. So, what defines a valid order block? When large traders or institutions take major positions, they leave footprints in the form of price movement. This is why order blocks are crucial. They reveal where smart money has entered the market. But to be classified as a valid order block, the area must meet certain criteria, making it more reliable for future trades. Here are the key conditions that define a valid order block. Inefficiency. For an order block to be valid, it should reflect an inefficient price move, where the market has moved sharply in one direction, leaving behind a clear imbalance in price. This often happens because large institutional orders move the market quickly, creating gaps or unfilled areas in the price action. This imbalance is an important signal that smart money is involved, and the market will likely return to that area to rebalance the price. Liquidity collection. A key feature of order blocks is their ability to collect liquidity. This happens when the market manipulates price, triggering stop losses or pending orders placed by retail traders. Smart money often uses these liquidity grabs to fuel their positions before moving price in the opposite direction. In a bullish scenario, liquidity is collected below support levels, while in a bearish scenario, liquidity is collected above resistance. Once this liquidity is swept, the market moves aggressively in the intended direction, and the origin of this move is what we identify as the order block. The final and perhaps most important criterion for a valid order block is that it must cause a break in market structure. This is what differentiates a regular supply or demand zone from an order block. In a bullish market, when price breaks above a significant previous high, the point where the price originated from becomes an influential demand area, known as a bullish order block. Conversely, in a bearish market, when price breaks below a key low, the area of supply that caused the breakdown becomes a bearish order block. This structural break confirms that smart money has participated in the move, reinforcing the significance of the order block for future price action. Let's dive into a real chart example to help you understand how a bullish order block forms and how you can use it in your trading. In this example, the market had been trending downward, creating lower highs and lower lows, indicating a bearish trend. However, as the price approached a key support level, we notice a sharp price reversal. This reversal creates the foundation of our bullish order block. Here's how to break it down step by step. Identify the market structure break. As the market reached a significant low, it reversed sharply, creating a higher high and breaking the previous lower high structure. This break in market structure is critical because it indicates that smart money has stepped in, shifting the trend from bearish to bullish. Find the origin of the move. After the market structure is broken, look to the origin of the bullish move. This area represents the order block, where smart money accumulated long positions. In this case, it is a strong bullish candle near the bottom of the downtrend, right before the reversal. Check for price imbalance. A clear fair value gap or price imbalance is left behind after the strong upward move. This gap further confirms that institutional buying caused the price to move aggressively, leaving unfilled orders that the market may return to fill. Watch the price return to the order block. After the initial bullish push, the market pulls back and returns to the order block. This is where we wait for confirmation of a potential long trade. The price enters the order block, testing the demand zone where smart money had previously entered. Look for confirmation and execute the trade. As the price revisits the order block, we look for confirmation signals such as rejection wicks, a structure shift, or bullish candlestick patterns. These signals indicate that the order block is holding as support. Once the price begins to move higher from the order block, you can enter a buy trade in alignment with the bullish momentum. Now let's go over a bearish order block example, which works similarly but in the opposite direction. In this chart, the market was trending upward, forming higher highs and higher lows. But as the price reached a significant resistance level, the market failed to continue upward, creating a sharp reversal and breaking the previous higher low structure. This break in structure signals the beginning of a bearish trend. Step 1. Identify the market structure break. After the price fails to make a new high, it reverses and breaks the most recent higher low, confirming that the market structure has shifted from bullish to bearish. Step 2. Find the origin of the move. The origin of this strong downward movement is the order block, where smart money likely entered short positions. This area is often represented by a large bearish candle right before the sharp move downward. Step 3. Check for price imbalance. A fair value gap or price inefficiency forms as the price drops quickly, signaling that the market may return to this zone before continuing lower. Step 4. Watch the price return to the order block. After the initial downward move, the market retraces upward and revisits the order block. Here, you can wait for the price to test the supply zone created by smart money shorts. Step 5. Look for confirmation and execute the trade. As the price re-enters the bearish order block, look for signs of rejection or bearish patterns to confirm the resistance is holding. Once you see these signals, you can enter a sell trade, anticipating further downside movement as the bearish trend resumes. Next up, breaker block, a key smart money concept. A breaker block occurs when a previous order block fails after a liquidity sweep or a market structure shift. Even though smart money concepts are highly effective, no strategy is foolproof. Traders using smart money concepts may buy at bullish order blocks and place their stop loss below the low of that order block, or sell at bearish order blocks with their stop loss above the high. However, market makers often take advantage of these positions, hunting stop losses and moving the market in the opposite direction, breaking the order block, which transforms it into what we call a breaker block. Just like order blocks, breaker blocks come in two types: bullish breaker block, bearish breaker block. A bullish breaker block occurs when a bearish order block fails. According to ICA, all up closed candles before a swing high that sweeps liquidity and then gets broken can be considered part of the breaker block. However, the last up closed candle is often the most significant. In simpler terms, a bullish breaker block is a failed bearish order block. When the price closes above the high of the bearish order block after sweeping liquidity and shifting market structure, the previously bearish block becomes support, and we refer to it as a bullish breaker block. To identify a valid bullish breaker block, look for the following conditions: a valid bearish order block. The price closes above the high of the bearish order block. A liquidity sweep has occurred. There is a market structure shift. A bearish breaker block is the opposite. It's a failed bullish order block. When the price closes below the low of the bullish order block, that previously bullish order block becomes resistance and is now known as a bearish breaker block. To confirm a valid bearish breaker block, you should check for the following: a valid bullish order block. The price closes below the low of the bullish order block. A liquidity sweep has occurred. There is a market structure shift. Now, let's dive into the bullish breaker block trading strategy. We generally prefer to trade with the trend because, as they say, the trend is your friend. Therefore, we look for bullish breaker blocks in a bullish trend. Here's the process. In a bullish trend, when the market creates a bearish order block, sellers are often drawn in. Instead of the price continuing lower, the market sweeps the stop losses of these sellers and breaks above the bearish order block. Once the price closes above the high of the bearish order block, sweeping liquidity and shifting the market structure, the broken bearish order block becomes a bullish breaker block. We then wait for the price to retrace to the bullish breaker block. When the market tests this area, it's an opportunity to execute a buy trade. Look for further confirmation on lower time frames, such as a market structure shift or rejection from the bullish breaker block zone. If you're trading on the daily chart, as in the example provided, there is no need to look for further confirmation on lower time frames or conduct a top-down analysis. The daily chart inherently offers higher probability setups due to its strength and reliability in capturing broader market movements. When executing a trade using the bullish breaker block, it's advisable to place your stop loss 10 to 20 pips below the low of the breaker block to protect your trade in case the market retests lower levels. Next, let's explore the bearish breaker block trading strategy. Similarly, in a bearish trend, we use the bearish breaker block for sell trades. Here's how it works. In a bearish trend, the market might form a bullish order block, drawing in buyers. However, instead of continuing upward, the market sweeps the stop losses of the buyers and breaks below the bullish order block. When the price closes below the low of the bullish order block, indicating a liquidity sweep and a shift in market structure, the broken bullish order block turns into a bearish breaker block. We wait for the price to retrace back to this bearish breaker block, and when it does, we look for opportunities to execute a sell trade. As always, you should seek further confirmation, such as a market structure shift or price rejection, in lower time frames before executing the trade. If you're trading on the daily chart, as in the example provided, there is no need to look for further confirmation on lower time frames or conduct a top-down analysis. The daily chart inherently offers higher probability setups due to its strength and reliability in capturing broader market movements. For bearish breaker block trades, place your stop loss 10 to 20 pips above the high of the breaker block to protect yourself from any further price movement in the opposite direction. Now, let's move to the next ICT concept, market structure shift. A market structure shift occurs when there is a clear change in the market's directional trend. In a typical market environment, prices follow trends moving either upward or downward, creating higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. When this pattern breaks and the market changes direction, it's referred to as a market structure shift. Market structure shifts are vital to understanding how smart money operates. as they often mark the point where large institutions are reversing the trend to trap retail traders and move the market in their favor. Recognizing these shifts early can help traders position themselves in line with institutional order flow. A bullish market structure shift occurs when the market transitions from a bearish to a bullish trend. In a bearish market, the price creates lower highs and lower lows as it moves downward. A bullish market structure shift happens when the market moves upward with displacement and breaks a previous lower high. This lower high is significant because it has already taken out a previous low, and breaking it signals that the bearish trend is over. In simple terms, a bullish market structure shift is when price starts to break through important resistance levels in a downward trend, indicating that the market is now shifting upward. A bearish market structure shift occurs when the market transitions from a bullish to a bearish trend. In a bullish market, the price forms higher highs and higher lows as it moves upward. A bearish market structure shift occurs when price moves downward with displacement and breaks a significant higher low. This higher low is important because it has already taken out a previous high, and breaking it signals that the bullish trend is likely ending. In summary, a bearish market structure shift is when price breaks through important support levels in an upward trend, signaling that the market is shifting downward. Next, let's cover how to trade a bullish market structure shift. When the market shifts from bearish to bullish, the objective is to catch the reversal while using displacement, fair value gaps, and order blocks to optimize trade entries. Here's the step-by-step process to trade a bullish market structure shift. Identify the shift. Once you see the market break the previous lower high with a displacement move, the market structure has shifted bullish. Wait for a retest. When the market pulls back and retests the order block, look for confirmation that the market is respecting these levels. Execute a buy trade. Once you have confirmation, execute a buy trade. Your stop loss should be placed 10 to 20 pips below the order block zone, and for your profit target, aim for a 1 to 2 risk-reward ratio. In a bearish market structure shift, the market is transitioning from bullish to bearish, and the goal is to capitalize on the downward trend using similar concepts. Here's the step-by-step process to trade a bearish market structure shift. Identify the shift. When the market breaks the previous higher low with a displacement move, this confirms that the market structure has shifted to bearish. Mark the key areas. Identify any relevant fair value gaps, order blocks, or breaker blocks. These zones are potential areas for the market to retest before continuing the bearish trend. In this case, a breaker block has been identified, which serves as a potential zone for the market to retest before continuing the bearish trend. This further confirms the likelihood of the market's continuation in the bearish direction. Wait for a retest. Allow the market to retrace upward and test the breaker block. Look for signs of rejection or confirmation that these areas are acting as resistance. Execute a sell trade. Once confirmed, you can execute a sell trade. Your stop loss should be placed 10 to 20 pips above the breaker block. For profit targets, aim for a 1 to 2 risk-reward ratio. That's it for today's breakdown of the top ICT concepts. I hope this video gave you valuable insights to boost your trading game. If you enjoyed this, make sure to hit the like button, subscribe for more in-depth trading strategies, and turn on the notification bell so you never miss an update. Drop a comment below with your thoughts or questions. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.